Good morning, everyone. It is 6 a.m., half an hour before the market is going to open on Thursday, June 20th. Hope you guys all had a great weekend, or not a weekend, a holiday yesterday. Maybe not a holiday for everyone, but the markets are closed, so a holiday from the markets on Tuesday before we had the holiday. The S&P did go up a little bit, tiny bit, very low volume. This amount of low volume has been historical. I've never seen this, and so I spent some of my time yesterday going back and looking and just seeing like, is this normal? Because it definitely did not feel normal for the volume to be this low, especially even given this time of the year. Yes, we do slow down in the summer, but not like this. This has been historical. This just doesn't really happen ever. So we're in a historically low volume period that is making it easier to push things around by large institutions. We haven't had a huge amount of volatility associated with it, but there is definitely the potential for volatility when there is low volume. And what we're seeing is that there is this divergence between the NASDAQ and the Dow Jones. Let's see if that's still there, actually. Well, not still, I'm sure it's still there. Just, are we making it worse or is it getting better this morning? And it's no better. It's definitely no better this morning. We've got the S&P up about 0.25%. We got the Dow flat, but slightly down, and then the NASDAQ up about 40 basis points. So it's non-random in the NASDAQ, up random or basically flat in the other two. So there is still that divergence or increasing divergence between the NASDAQ and the Dow. So when we have a market that keeps making new highs and all-time highs, and we don't have volume, and we have a disparity between the NASDAQ and the Dow, and we have a disparity between the number of stocks that are going up and going down. We also have, over the past few weeks, the number of stocks that have gone up versus the number of stocks that have gone down on a daily basis has been low, meaning that, yes, we're grinding higher on the market, but there's less stocks that are doing it, less and less. And we've seen that in momentum levels, but in actual advanced decline numbers, I wonder if TradingView has advanced decline ratio, okay, for the New York Stock Exchange. Okay. And you can see that we've been low, very low. This is the AD ratio, number of stocks that are advancing versus number of stocks that are declining. And you can see that this is low. We're way down here. We're not up here. And so we keep looking at, this is not the normal. I'm going to have to find it. Oh, I'll find it for the afternoon session. So the number of stocks that are pushing this market higher is anemic. And as we've pointed out in the week or two past, that it's really just a very small number, like six FANG stocks, tech stocks that are pushing this market higher. And it's getting worse. If we look at our momentum levels, what we see is that, let's look at our overall market, all stocks in the market above $2. If we look at our 50-day, last month, we were at 60% of stocks were above their 50-day moving average. Now we're only at 38. That is very far below the 50-day moving average. So if we go a month back to 5/20, May 20, okay, we closed at 5:30, and on Tuesday we closed at 5:48.5. Was it 530 or 520? 530, I think. 530, yeah. So we've gone up 3.5%, but the number of stocks that are still above their 50-day moving average has gone down to 38%, from 60% to 38%. So that's definitely not indicating strength. And the one that is really starting to get worrisome is this one, the 200-day moving average. We went down from 63.5% all the way down to 51.3%. Just barely above half of stocks in the overall market are above their 20-day moving average. And what happens when we go below 50? When we go below 50, that is the beginning, and that is a definition, one of the classic definitions of a bear market. So we're just a 1.3% away of calling the beginning of a bear market. So we definitely want to keep an eye on this. This is definitely not a healthy market. If I look at the other indices, it's probably not as bad in the NASDAQ. 48%, we're definitely below the 50% here. 200 day, we still have 66%. Let's take a look at but if we look at, these are concentrated and these are weighted. So, or sorry, this is not weighted. These are concentrated in just the largest cap stocks, and they don't include smaller cap stocks. So if we look at, for example, the Russell, 36%, 45%, we're already below that number. The small caps are already starting to fit the profile of a bear market. So if I look at the IWM, yes, it's looking stagnant right now. It's looking stagnant for a while, but all this has to do, look how far above the MA200 we are. But we have 45%, only 45% of the stocks in the Russell 2000 above the 200%. If this was equal weighted, we'd be down here already. So this is definitely not indicating strength. And it's really starting to get worrisome. So that's one thing that I was looking at yesterday, and to see that there's just so many signs that this market is starting to struggle. What we need to see is money to start going into other sectors other than the semiconductors. Money needs to come out of semiconductors and go into other things like financials and industrials and materials and consumer staples. We need to see more breadth in this market. And if we get money out of SMH and out of tech, what we'll see is a correction in the S&P 500 and the NASDAQ, because those inflated ones are the ones that are keeping us up. If that money, even if it redistributes to other stocks, that money will not be weighted the same way as the, where did this come from? It will not be weighted the same way. And what we'll see is a pullback because of that money movement, but not a huge drop, because overall the same number of dollars will be in the market unless money moves out of SMH and goes into things like bonds and commodities and gold and silver. Then money has left the stock market, and so yes, we will see a more pronounced pullback. But if it's just a redistribution, then it'll be mostly flat, maybe slightly down. So that's what we were looking for in order for this market to stay healthy and continue to be able to eventually keep on moving higher. Otherwise, what's going to happen is the underlying stocks in the market, which are the staples and the lower risk stocks, they're going to continue to fall. And that is eventually going to drag the entire market down. Because if your foundation isn't strong, then eventually it's going to bring down the roof. It doesn't matter. You can keep building the roof higher, but if your foundation goes, the whole thing collapses. So we're going to keep an eye on this very carefully. I'm not ready to say that we're in trouble yet. It's just that the signs are telling that unless the rest of it can become really healthy, then we're going to have a little bit of a tumble here. So if we look at SMH, that's going parabolic. It's still going up today. It's going to make it even worse. We've got, I think Micron got upgraded. So that's why in the pre-market, that's going to move up. But was it Taiwan Semiconductor or probably NVIDIA got upgraded as well? Yeah, we got a gap up today in NVIDIA. And in the meantime, the rest of the world is not looking that great. Second biggest economy, China. It's not looking great at all. It is above the MA200. It was able to do that. We got this giant pullback happening, and we do look like there might be a little bit of bounce off of that MA50 right there. But the news out of China is not good. Their real estate is really struggling. Their real estate bubble is still bursting. So we're not seeing that. And that was basically our financial crisis in 2007, 2008. And it took a couple of years. So I'm not going to expect this to just miraculously just, hey, we're done. We're good. It's going to take a little bit of time before that economy gets back on its feet. And so basically the US is going to have to carry the burden of the global economy for the time being, and I don't know if it can in its current state. So just things are not looking peachy, and we're talking about longer term stuff here, but we're starting to see it bleed into, it's starting to get closer and closer. It is going to start affecting us at some point. That some point probably isn't tomorrow, but it's not years away, and it's not several quarters away. It's like maybe between now and in a year from now. We're just starting to see that get closer and closer. Let's take a look at our bonds, because that kept on going. Looked like there was a lot of irrational in the market. We could see that pre-market, we're back down to where we opened in the previous one. So basically completely undoing the move on Tuesday. And what we were looking at is this Fed watch and the probabilities that are being priced into the market of rate cuts. And there's still 10% priced into July. And there is a whole host of reasons why I've told you guys that this number should be 0. And let's just see what, over the last couple of days, what the Fed has been saying. Members of the Fed. That's why I had this article open. Fed comments on Tuesday. This is just Tuesday. So very recent. So mostly hawkish. New York Fed Williams said that we're moving the right direction, but we need more data. More data is more data. We're not going to get more data until July. And so is that enough to move us, to get us a rate decision on July? The answer is no. But if the economy evolves as I'm expecting, it will likely become appropriate to begin easing later this year. That was Kugler. Then we got St. Louis Fed Musalem, I don't know how to say that person's name. It's likely to take quarters, not months, to see data to support a reduction. So this guy's talking about next year, well into next year, not in a matter of months, quarters. We only have one more quarter of data to see this year. From Logan, who said that we're going to need several months of data to have confidence. So that's what I've been talking about. When they say they need more data, they need at least 3 data points, not 1 more data point, 2 more data points. We need several months. This guy's saying even more than what I've been saying. So the likelihood that the Fed is going to cut rates in July, which is 40 days from now, that is definitely not 10%. It's very, very close to 0%. And when this finally matches that 0%, then we're going to see that tumble in the TLT. And it might just be to the MA50 or slightly lower to this 88 level, maybe not necessarily all the way down to the bottom channel here at this point, but that's still plenty of movement, plenty of motion. And those trades those example trades that I showed you about a week or so ago, those are still in place. They're still very valid. Everything is still on track. It's just we're waiting for the market to match the situation. It's sort of like this, it's disharmony in the market. So there's mispricing in the market, it's disharmony in the market. So disharmony in a human looks like my mind and my reality, my physical reality and my mental reality don't match. I have a certain feeling, I have a certain thought, and it's just not true. It's just not the physical reality of it. It's 110 degrees outside, and I'm sitting here like, oh, wow, it's so cold. I better put on a jacket. If I do that, I have disharmony and it's harmful to me physically. It's going to harm my health. We need to have harmony within our internal and external worlds. And what we're seeing right here is disharmony. There's the market is doing one thing and the reality of the situation is another thing. And that disharmony has to resolve itself. Either one, they have to match. So either one has to move or the other has to move. Either my mental situation has to start matching my physical situation, or my physical environment has to change to match my mental situation. So one of those two are going to happen, and it's most likely going to be the market moves to the situation. It would just be pure chance and luck if the actual situation moved to match the market. Just like normally it's pure chance and luck if your physical situation changes to match your mental situation. So if I go and I put on that jacket when it's 110 degrees outside, and miraculously the temperature drops 40 to 50 degrees, 60 degrees before I burn to death and dehydrate, then I'm just lucky. It's not that I actually affected my outside temperature. So either the market has to get really lucky, which is not that's called gambling, or the market has to come and match the reality, and that is called the investment, because that's the higher likely scenario. So we have a little investment going on. It hasn't been working out so far because of this irrationality, but we are assured that by July 31st, there will be harmony one way or the other. And we're betting on the far higher probable event. So let's take a quick look at our sector is not going to be that meaningful today. So we've got a holiday. We're coming back from a holiday. A lot of institutions or higher level traders and managers at the institutions will have taken this opportunity to take a long weekend. So they automatically get Wednesday off. They automatically get Friday, Saturday off. They'll just take vacation on Thursday, Friday as well, and just make it a really long weekend. So we're not expecting huge amounts of volume today. That could introduce volatility. That could give us a chance to push things around. It looks like we're sloping off this morning. So there might have been, I don't think there was any significant reports here. Yeah, nothing too crazy. Let's just see housing starts and permits. Lower than expected. Jobless claims, a little bit lower than expected, but really insignificant. Philadelphia Fed, far lower than expected. So we might be reacting to this, because that's a really big rate, a really big miss right here. But that consensus rate was huge. So I don't think anyone should have been investing based on or trading based on this report. If they did, then that could be grounds for being fired. All right, and then nothing else. Yeah, nothing else. So it's probably this Philadelphia Fed, which shouldn't really be a big deal. This is a 550.5 down to so 1 point. Yeah, not hugely significant. So not expecting too much movement. Well, maybe movement, but not the volume. So it's not a movement that we could really trust. And then, of course, Friday is quadruple witching. So there's going to be a scramble of activity that could cause volatility and distorted pictures tomorrow. So we're not going to really trust what we see tomorrow either. Even if we see volume, it would It could be artificially high, just like the volume on this day was artificially high because of the algorithmic trading on the FOMC announcement. We'll have a similar potential for a similar thing to happen tomorrow. So we want to be aware of that. And if you have any options that are expiring tomorrow, it's probably a good idea to just trade out of them today. Either close your position or roll your position. So it's a good idea to not get caught up in that crazy activity tomorrow. So we're expecting a quiet day for the most part, and then a hectic day tomorrow. So we'll see how the day actually turns out. We'll get updated. I'll look for the actual advanced decline number, and then we'll go over that in the post-market session. All right, guys, have a wonderful rest of your day, and I'll see you in the post-market.